Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Atmos Energy, ticker ATO. Over the next 5 minutes, I'll discuss both my thoughts on the valuation of this company and its business quality. Let's dive on in. First up, this company is a gas utility company, which tells us a little bit about its industry. So it deals in the regulated natural gas distribution, pipeline, and storage business in the United States as both distribution and then pipeline and storage. So it's a regulated natural gas and sales operation in 8 states. That regulated is important because it generally means that they have controls on what it can return to shareholders. The beta of 0.5 is significant because it tells it's a relatively low volatility stock compared to the average stock in the S&P 500. It means it's probably low volatility for the business, which is kind of what we see here when we look at the return on invested capital numbers. The first thing that leaps out to me is that this return on invested capital is 20 straight years of profitability. That's a very positive thing you want to see when evaluating the quality of a company. No years of losses is very good. It means that you have the ability to compound over time. The second thing that leaps out to me is that all of their return on invested capital is hidden around this 5% marker. So basically you've increased from about 4% in 2002 up to about 5% in 2021, 2020. And so you've increased your return on invested capital about 1% over the last 20 years, but it's still around 5%. You're not at the 10% level. You're not at the 15% level. It's a relatively low return on invested capital. So that's a negative for the quality, but the positive is that it is stable. It is a stable and increasing return on invested capital. You like to see that. That's a good sign. Now, 10-year median returns tells us return on assets 3.7%, invested capital of 5.4%, and return on equity of 9.9%. So they're using some leverage to get that return on equity number up, which is what you want to see. You really want that number to be double digits. A 10%, 15% return is really what you want to see for return on equity at a minimum, and you're not hitting that. But it does show that they are understanding that they're running it low, and so they need that debt to provide the leverage. So this is a little low for me. Again, a negative in terms of quality. Now on valuation, it's low. You have a PE of 22, but that's kind of high too. So if you think about that, that's like an earnings yield of 4.5%. So earnings yield of 4.5% means if they don't grow, you should expect maybe a 4.5% return, assuming they can return the capital to shareholders. But they aren't growing. They're not only not growing, but they're having a reduction in revenue over time. This means on a stability basis, you should expect a return of like 2 to 3%. You already take that earnings yield of 4.5, you subtract the revenue declines of 2%, you get maybe to a 2.5% return expectation. That means that this company is very heavily overvalued compared to its revenues, assuming the last 10 years is normal. And what you see really is you had some growth from 2012 up to 2014, and then it crashed in 2015. So this is possibly a sale of some of the business, and then they've continued to maybe grow some since then, which you have seen from 2016. They've grown up to the 3.4 billion in revenue there. So maybe they got rid of some of the business, and that could play a part in the numbers we're seeing here. In order to take a look at that, let's look at the balance sheet maybe. Maybe we'll have see if we can see something about, maybe cash flow. Do we see any acquisitions or sales? I'm not seeing anything that they got any income from that. So it's hard to say. Now, the other thing that you see here that's really bad when we look at the income statement, and before I dive into that income statement, don't forget to like this video and hit the subscribe button if you're enjoying what I'm covering so far. Your likes and subscriptions help me to grow the channel, help me to find new users. I would really appreciate that. So hit that subscribe button and let's keep going. So on the income statement, we can see that the shares outstanding has grown from 90 million to 130 million over the last 10 years. So they're steadily diluting shareholders. That's the only way they're even able to grow the amount that they have, is by continuing to dilute shareholders. That's a really bad sign. and suggest that although their net income is growing faster, so it basically means their net income is growing faster than their earnings per share, which is not good for you, not good as a shareholder. In order to grow, they have to dilute you because they don't have the returns on invested capital to justify growth without it. And so balance sheet, you're going to see that they've tripled their plant and PP&E, which is where you see this kind of 10% growth in assets over time. Actually, let's see if we see a drop in PP. So you actually don't see a drop in PP&E in that 2014-2015 timeframe. So they probably didn't dilute. They just started having worse returns in that timeframe. So that's really bad for them as a business. If we go to the cash flow, you see there's a constant dilution from stock-based compensation. There's also a constant dilution of them issuing shares simply to fund their business. And so that's really bad in terms of helping shareholders get a long-term return. So for me, Atmos Energy is a pass on quality. The returns simply aren't high enough. It's a pass on valuation because you can't justify paying a PE of 22 if your revenue is declining. Something on the range of a PE of 8 might justify a revenue decline of 2%, but if they're growing, then maybe a higher revenue. But really, I can never justify paying for a company that only has a return on invested capital of 5%, because it means if I hold it for the long term, I'm highly unlikely to get more than a 5% annual return myself. Thank you for listening. Don't forget to like and subscribe to this channel. And until next time, stop paying fees, start building wealth.